This is the Debunking Economics Podcast with Steve Keen and Phil Dobbie.
The Archives.
Episode 317. Shadow banks. Necessary or a force for evil?
We need now to work double hard to overturn
on the inflation rate and the unemployment rate. It's called the Phillips curve.
The government is too big, it's too intrusive, it restricts what we can do.
How does he look within, given the grim data of the debt?
Government budgets don't work like household budgets.
This is the Debunking Economics Podcast with Steve Keen and Phil Dobbie.
Well, we've all heard of shadow banks, but do we understand exactly what they are? I mean, they sound pretty bad, don't they? Shadow implies shady deals, and they were to shoulder most of the blame for the 2008 financial crisis. But they must be doing some good, surely. Otherwise, regulators would never allow them to do business. Would they? Instead, well, they work outside most banking regulation. So does that make them the Wild West of the finance sector? That's this week on the Debunking Economics Podcast. So shadow banking is quite a big thing. It was particularly big up to the 2008 financial crisis, which most would agree was caused really because of shadow banking. But since then, it's grown in size even more. By 2016, it was worth around the world over $100 trillion. So what are they? What are they doing? Are they distorting the banking sector, or are they a necessary force for good or evil? Do they perhaps keep banks honest, for example? Is that even possible? So, Steve, I mean, maybe we should start with the real basics here, because it's a term that is used a great deal. What exactly is a shadow bank?
Fundamentally, it's an institution involved in finance that doesn't have an account at the central bank. That's in a simple nutshell, pragmatic definition. That's what they are. In practice, they tend to be several sorts of companies. There's ones which spread the risk of episodic events in human life. So the insurance companies on the one hand, to some extent the pension companies on another. Then you've got others which are involved in underwriting, share purchases, etc., etc. They're the ones we normally think of when we talk about shadow banking. That's the Morgan Stanleys and the Goldman Sachs and so on. And their business is predominantly consulting with other firms to advise on how to undertake mergers and acquisitions, how to move in different markets and so on. But they also do some lending. But I think the main thing the shadow banks are, that's where the word shadow in Plato's caves come to mind. You see the shadows, you're not actually seeing the players. And I think the groups that are casting the shadow of shadow banks are the actual banks.
Right. Okay, we'll explore that a bit more. There is, by the way, a move afoot to try and get rid of the term shadow banking, because it's got connotations of 2008, etc. And they want to use the term market-based finance. Steve, how wanky is that?
More bullshit. More bullshit. That's what crazy. I mean, you think about why did shadow banking evolve? The main reason is that you have banks which could not undertake investments in other potentially lucrative businesses because of the fiduciary limits and rules on what a bank can actually do on the asset side. So fundamentally, it can have reserves which are created by government spending, loans which it creates by private lending, and bonds which it buys off the government. So those are the three sort of things, and shares aren't mentioned there. But if you spin off a company and you call it a shadow bank, then that shadow bank, you can give it a loan and say, okay, you can now go and use the money I've lent you to go and gamble on asset markets. And that's fundamentally what they've done, a combination of gambling on asset markets plus trying to game things like the American housing market in 2007.
So you're saying the shadow banks very often are funded by, well, the money's got to come from somewhere, I guess. They are coming from banks. So banks are lending to the shadow banks because banks can create money that shadow banks can't. And then the shadow banks are using that money that has been created by that loan from a bank to engage in more risky practices that by legislation banks are not able to undertake. Is that what we're saying? So in other words...
Pretty much, yeah. I mean, I don't know that the shareholders of merchant banks are the banks themselves today, but this is something where a historian or an accountant could actually give a better record than I can. But I imagine if you go back in time, you'll find that the reason they were created was to get around the limitations on the asset speculation side of real banks. And I would be not at all amazed that the banks themselves said we have to set something up so we can exploit this pot of money we can see over there. Because to quote the West Australian Premier when talking about one of Australia's great Ponzi schemers, he said he'd hate to stand between Laurie Garrett, I think it was, to stand between Laurie Garrett and a bucket of money. So I think the regulatory constraints on what banks can do is what led to the formation of shadow banks.
Right. And, it's grown bigger and bigger, although they've been around for a long time, haven't they? Because would a building society be classified as a shadow bank? Because building societies
the building societies are a very interesting example because they are literally the textbook idea of how lending occurs. You put your money in a building society. You do not have a withdrawal account. Okay, if you want to withdraw your money, you've got to sign a form and do it in 30 days. What is happening with your money? It is being lent out to other people in the same building society who are building a house with it. And when they've gone through the whole cost of doing it and repay the loan, then your money might be recompensed and you can then take it out. But that's classic peer-to-peer lending, and that's and because building societies dominated the UK housing market until 1982. That's one reason why private debt remained so low in the UK. Historically, it never exceeded 73% of GDP in data going right back to 1880. But as of 1982, when Maggie deregulated the mortgage market and let banks lend into that market, then you had institutions which actually can create money, funding purchases of housing, and that caused the bubble. So the building societies are a form of shadow bank I'd like to see continuing. You might call them community banks rather than shadow banks. But the shadow bank world, I think, deserves the opprobrium that Keynes had once when he said, when the investment actions of a country are based on the outcomes of a casino, the job is likely to be all done. Well, I think merchant banks have been a positive disincentive to good behaviours and good opportunities in capitalism. And I wouldn't be at all sorry to see them go. Of course they won't. They'll be around to kingdom come.
Doesn't the problem occur when the money which is being put into a shadow bank is fundamentally a loan? So if I've got some money and I put it in, I go to a building society and say, look, all I've got, I've got £10,000, I want to buy a house, give me a loan. But if I go along to another, that's all fine. That's all seems above board and legitimate. But if I go to another institution and say, look, I've borrowed £1 million to invest in shares, and however else you can make this £1 million grow. By the way, I've only got 10,000 in my bank, but I've borrowed $1 million. Isn't that part of the problem? I mean, and isn't that easily regulated against?
Definitely. I mean, that's what, if you look at the level of margin debt, for example, that's a classic case of shadow banking activity. And people, invest in shares, and they say, "Oh, would you like to do it with margin lending?" Oh, what's margin lending? Oh, it's simple. You put down $500,000. We give you a loan of $500,000, and with that $500,000, with a total $1 million, you can go and buy $1 million worth of shares. And if the shares increase in value by 10%, your profit is not 100,000 on $1 million, it's 100,000 on 500,000. You've made a 20% gain. Isn't that great? Works well until the stock market crashes. Yeah,
but where's that shadow? In that instance, it's slightly different to what I was talking about, so we'll go back to that. But in that instance where you go to a shadow bank and they say, I've got $500,000, they say, well, we'll give you $500,000 as well as a loan. Where they're getting, if they can't create money the same as as a bank, that's how do they create that $500,000?
They've got, first of all, they had seed capital decades ago. That's always an important starting point. They've bought into the share market. They've bought into bonds. They've got revenue coming out of each of those, and they can also liquidate shares to make a loan to an individual if they expect loan rates to be higher than the rate of growth of the stock market over time. So the money has to be given to them. They can't create it on their own. But that, rather than making them a better behaving bank, has actually made them worse behaving banks than the main banks because they use that power to cause speculative bubbles on stock markets. And I don't think there are many people left who think that speculative bubbles are a good idea. after the experiences of the last 40 years.
I mean, it keeps on going on, doesn't it? But I mean, but they have to have that 500,000. I mean, it would be hard to track, wouldn't it? Because the money is moving all the time. Share prices are moving all the time. The value of the assets that they hold, obviously, are changing all the time. But the margin call issue is when they have lent that 500,000 to that guy based on the share values that have, for example, halved in price since. And that's where they run into trouble.
Yeah, and that's what we saw during the Great Depression as well. Margin lending back in the Great Depression used to be not 50% but 90%. So you could put down $100,000 and buy $1 million worth of shares. But if the shares went up by 10%, you made a 100% profit. If they went down by 10%, you're bankrupt. You wiped out all your equity in that position. And that's where the margin call comes in. That the stockbrokers, according to the contract of the loans they signed with these speculators, are entitled to take any asset you've got to meet your debts to them. So if let's say if you had like a 20% fall in the market, you would go from having, say, 110,000 to 90,000, 900,000. That's after your previous gain. And your portfolio now has none of your money in it. So the brokerage can ring up and say, you've got to give us $100,000. We don't care how you do it. If you have to sell your car, go and sell your car. But you've got to liquidate, you've got to pay it now. Now, that's what led to the severity of the downturn in 1930. Margin debt went from being 13% of GDP to half of 1% between the stock market crash in 1929 and the bottom of the Depression in 1933.
Right. So my point was not about how you get margin calls because those shadow banks have basically said, yes, we can add to what you're putting into the money. My point was relating to the money that you're putting in the first place. Now, there's a difference between me saying, oh, look, I've saved hard, I've got £10,000 sitting in my bank account versus, oh, look, I've got 500,000 because I've just got this loan from my bank. So it's money that the bank has created that is being put into these shadow banks, which gets to the point, that could be me, or it could be the bank that's created that money for itself, and it's just happened to be using me as an intermediary. There's no way of knowing, is there, that, how in the sordid world of banking, how money moves around. But if it's borrowed money or created money that's finding itself in the shadow banking sector, then that just expands the shadow banking sector even more, doesn't it? And that is a long way from those those nice, friendly local building societies that were only lending out money that they'd received.
Yeah, a very huge difference. And I think this is one reason, as I said, I think it's why the banks formed shadow banks in the first place. But it's also this whole idea that they can borrow themselves from banks. So the borrowing from the banks itself creates money, which of course turns up in the financial sector. And what we have is a maelstrom of financial speculation, but very little investment. So this is one of these cases, yet again, where letting the market rip has failed. And fundamentally, a banking license is a license to create money, but not a license to rip money off. But the latter is what's actually happened as the power structure between corporations and governments have shifted so strongly in favour of particularly financial corporations.
So how do you change that happening then? If you were, so is there anything there's nothing to stop a bank with a banking license saying, well, we are going to invest in the share market because we've got money and we need to maximise the return. There's nothing to stop them doing that. I mean, if they've got money sitting in reserve, so I've put money into the bank, it's gone into the bank's reserve.
They do face rules saying they can only invest in low risk government securities, some low risk corporate security. The rating has to be high enough, and bonds. And that's what they do. So on the asset side of banks, it's actually quite boring. You want interesting stuff, you go across to the Goldman Sachs of the world.
Right. Okay, which are shadow banks in effect.
Yeah, that's the shadow banks where you'll have a complicated portfolio of shares and speculative positions and so on. The private banks aren't allowed to do that. They've got strong limitations on what they can have as assets and what they can do.
And you can understand why. I understand why they'd have that limitation, because you don't want those banks to all of a sudden collapse and people who've got money in those banks lose out as a result of it. But couldn't you actually, to avoid all of this shadow banking nonsense happening, couldn't you say, well, okay, you can invest in shares, but you've got to allow a certain amount of leeway. We've got to allow 50%. Let's assume that the share market never falls by 50%. So, will you get a better return by investing in shares than you would in bonds if maybe 50% is a bit high, but you set limits so that there's or you have to put money to one side to ensure that you can cover it should things turn bad.
Yeah, and that's the sort of stuff we should be doing, but that takes politicians who are aware of the actual balance of power lies with them and not with the shadow banks. So the shadow banks, again, an expansion of the power of the financial sector. And my favourite instance of that was John Paulson. Was it John Paulson or Hank Paulson, who was Treasurer of the Secretary during the financial crisis? And he was an ex-Goldman Sachs executive. And he got a call from one of his Goldman Sachs colleagues saying, "You've got to do something. If you don't do it soon, we're going to go bankrupt." And Hank Paulson, this is in his book, I've forgotten the actual title of the book, but about the financial crisis, about something on the brink. So Hank asks his ex-colleague from Goldman Sachs, "How long have you got?" And the answer was, and I quote, "About 3 hours." Now, what's going on?
Yeah.
What's going on there is, of course, this plunging stock market. Stock market shares are an asset of the shadow banking sector. They're required to have positive equity, not quite as strictly as actual banks are, but they still have to have positive equity. If their assets fall in value compared to their liabilities, they're bankrupt. Now, because shadow banks can buy shares and so on, then their asset side is subject to that volatility. But because banks can't, their assets aren't as volatile.
In a nutshell, then what we're saying is the regulations that have been imposed on mainstream banks, on banks that have got deposits in the central bank, those regulations have just shifted all this risky behaviour to the shadow banking sector. And it seems like nobody knows how to regulate it, or indeed whether they do need to regulate. I mean, is there an argument that maybe shadow banks do some good? Now, don't answer that, because actually what we'll do is we'll come back in just a second and we'll explore that. I'll give you a chance to think about that, Steve. Are there actually any good factors about shadow banks apart from obviously those friendly local building societies, which we all clearly love? We'll look at that next on the Debunking Economics podcast with Steve Keen, and I'm Phil Dobbie. See you in a second.
This is the Debunking Economics podcast with Steve Keen and Phil Dobbie.
So, Steve, I asked the question, is there any good done by shadow banks beyond the work of building society? I mean, I know one of the arguments given is that, they are adding extra competition to the banking sector. That if there's more people providing services, whatever those services might be, then that is surely good, because there will be innovation in those services. There will be better services for consumers, perhaps lower prices for consumers. Isn't that a good thing?
Yeah, well, I think if you think of the activities that I don't like them doing, it's financing share buybacks, it's doing speculation on their own account on the stock market and so on. But one thing in merchant banking is inherently more innovative than normal banking, simply because of the controls on what you can do as a banker in terms of what assets you can buy and so on. But because those controls don't apply to the shadow banking world, that leaves a lot of people who would otherwise work in banks and be working out how to give loans to corporations with good new ideas. They go across to merchant banks, and the merchant banks there take an equity stake and provide the money in that sense. So there is a way in which they're more likely to do innovative investment. But the trouble is they're as socially irresponsible as any other element of the financial sector, and there's no guarantee that the things that they fund are going to be what society needs in a decade's time. It might well be what some entrepreneur needs in the next 6 months, but it's not what society needs overall.
Right, but you're never going to be able to regulate against that. And also it's a judgment call anyway, isn't it? I mean, you could similarly say, well, they've invested in things that could have been really good in 10 years' time, but they failed because they were badly managed, for example.
Yeah.
Where do you draw the line?
Yeah. And so they have massively expanded the innovative side of the financial sector, but that innovation hasn't turned up in them enabling a large range of new manufacturing products. I mean, there are some cases. Tesla, for example, is a company that got its start through a shadow bank in Boston in terms of funding it to go from the Roadster to production level. I think the first one was the Model 3. So they do some stuff that banks would turn down, because it's banks, if they're going to make a loan, they've got to secure it against an asset. Whereas with the shadow banking sector, they can secure it against an idea. and that is expose them to more risk, but it also means they potentially can do more innovation. But as I've said, I'm pretty skeptical about the sort of innovation they've done.
So is that right? A bank, because I know if you go to a bank, and you want to get a loan, the first thing they'll ask is, have you got a house? They're desperate to find something that they can nab back off you if it all goes wrong. They have to do that by law, or is that just the way they operate?
It's how they operate. Like in terms of a mortgage has to have a lien against a property, but they can also assess whether you're capable of taking out the mortgage by looking at your income and expenditure over time. If they do that intelligently, then they're going to match you with an asset you can actually afford. But if they're caught up in the bonus side of the world, and this is where we get the catastrophes we've seen in recent decades, if they get a bonus for the loans they issue, they're willing to issue those loans even if you don't pass due diligence, because the higher level of loans means the higher level of not royalties, but bonuses to the people writing those loans. So there's a really corrupt mindset that's automatically part of the financial system that encourages wasteful speculation and not the useful sort of speculation that Keynes was hoping for.
Now, just imagine I've got an absolute future-proof business idea. And I just need I have discovered, for example, in my spare time, the answer to perpetual energy. And it's going to. So I just chanced upon it. It was.
Let's put a pint of beer on the handlebars of Phil Dobby's motorbike, and it goes on indefinitely.
Yeah, that sort of thing. I was cooking actually. With a mix of ingredients. I got the recipe wrong, and I don't know how it happened, but I discovered perpetual motion. It's you need the right ingredients. So
you're off to market.
I need to scale it up, obviously, to because you need lots. Because the thing about perpetual energy is you need lots of it. So you could argue you only need one of this device, but it's very expensive anyway. So I go to my bank and say, look, I've discovered perpetual energy, and they go, okay, but you're going to need to put your house down as a deposit. And I go, my wife's not going to be very happy about that. I don't know how I can do it. Is that the way it would work? Or could a bank say, wow, perpetual energy, that sounds like, even to me, and I don't know much working in this bank, that sounds to me like a money spinner. We're prepared to give you what you need based on the return you're going to give us. Can they actually physically do that if they wanted to?
They can physically do it. But
they don't.
Well, because when you look at the history of entrepreneurs, I mean, I don't know the actual numbers, but I imagine 8 out of every 10 entrepreneurs fails. 2 go off to be marvelously successful, but the other 8 can fold, even with good ideas. So, and I've seen plenty of examples of good companies going under with good ideas, but they failed to get the finance to keep on operating. One was an Australian company called Dull Meissen that made the world's first truly portable, powerful laptop computer, and that failed because they couldn't get funding because the banks weren't willing to mortgage the idea. They wanted to mortgage the property, and their property wasn't worth enough to fund the concept. So in that sort of world, you do want to have firms like shadow banks, which are looking at both lending to speculative businesses like that, or getting them to go through an IPO and getting onto the stock market and raise the revenue through an IPO. So that's the worthwhile work that shadow banks do that private banks, standard regulated banks can't.
But you're saying they can, but they don't. Because I mean, if they could give me a,
they could.
So why would they create shadow banks themselves if they could do it themselves? Why that need to separate out?
Well, they can't organise an IPO. Okay, they can't tell somebody, we're going to give you, here's the money we're going to raise for you from an IPO. They can't do that. So the merchant banks are the ones that can, and that's why they shift. So much activity goes through them these days.
Right. So that's a failing. That's a failing of regulation of the banks.
Well,
then,
yeah. I mean, if you go back sort of 40 years, you'll find that one of the major businesses of banks was issuing what they call lines of credit. Now they speak lines of cocaine, but let's go back to history. So lines.
Allegedly,
hello, banking friends. So with the
I think those days are gone. Actually, Steve, I suspect that those days have gone. Maybe not. Anyway, carry on. Yeah.
Okay. They used to offer what are called lines of credit. So a major corporation would line up 20 or 30 lenders and negotiate an aggregate line of credit of, say, $1 billion. And then that meant that if they faced higher wage demands or higher energy demands, they could instantly meet the costs by accessing part of that line of credit they have. So it's effectively like a credit card. Now, they've been virtually eliminated over the last 40 years because they weren't seen as profitable enough for the banks. So what has happened instead is major corporations now finance themselves in what's called the commercial paper market. So they will issue bills with a maturity date of 100 days or even less, and give a face value of, say, $100 on the bill, and pay 102 to buy it back at a future date. And that's become how these corporations have funded themselves.
Right.
But what you should have had... Because
that line of credit is a liability to the bank that's not being acted on. So they've got to have that money assigned, but that money's not working for them.
They can create that money, but the return wasn't as high as they liked. So I think it was much better to regulate the banks and require them to provide that sort of finance, because one of the essential roles of banking should be to provide working capital for corporations. But because they've got so caught up in funding housing scheme bubbles in the housing sector, and also the other merger and acquisition and style operations of the shadow banking system, we've lost that easy finance for major corporations, which means the corporation, which should be robust, are fragile when a crisis hits. And that happened to GM. I think they had weeks to go before they couldn't reach payroll because the commercial market, paper market collapsed. That was, I think, one of Lehman Brothers had cornered that particular market. So the collapse in the overall economy meant the collapse of the Lehman Brothers meant there was no market through which you could sell short-term paper by corporations, which meant in a matter of weeks they'd run out of money, be unable to pay wages. That's why there was such a panic after the collapse of Lehman Brothers.
Let's get back to those, our friendly local building society, which are, obviously representative of all that's good in the world. No one in the finance industry will end up in heaven except for the people in building society. I think that's the conclusion we've drawn today. But the logical thing to do, if you were one of those building societies, I think this is what really led to 2008 and the work of shadowy banks bringing down the economy. If you were a building society that could only loan out money that you in effect had, that money you'd received in, you'd be looking at a way, well, how can we do more? How can we loan out more than we have? Which is why you started to get loans being parceled up and then sold as securities. So those, whoever it is who's issuing those mortgages would go and say, well, okay, here's these people are going to be paying back. They've got a house. If it all goes to S, there's a house you can call on. But fundamentally, these are loans that are going to be paid back over time. There's money in this. We'll parcel it all up, and we'll sell it on as securities so that it could be bought by other institutions. I mean, that is just, and you can understand why that would happen. If you can't loan out more money than you've got, you're going to look at doing stuff like that. The question is, should you be allowed to?
Yeah, I mean, I think there's no doubt that merchant banks have gone too far in what they do. And I would like to see them effectively being banks for entrepreneurs. That'd be, and banks that can both issue loans and take equity positions in entrepreneurial ventures. That's the sort of a responsible use of shadow banking. But the negative is, they've got caught up in they do some IPOs, but they do lots of mergers and acquisitions. They do lots of share buybacks and so on. And I see that as destructive. But if we had them doing the shadow banks being the banking sector for the entrepreneurs, and the normal banking sector being the banking sector for existing firms, so lines of credit and household purchases, then we'd have a much more healthier financial system, which of course we don't have.
And they are offering competition to banks or doing stuff that banks wouldn't do. And they're not expanding the money supply in the process, so because they can't issue loans. So is that a good thing? I mean, that means that we are not getting the money supply expanded in a way that the central bank, for example, has very little ability to control.
There are people.
Or does it not matter?
It does matter, because if you're giving emerging banks the power to control money, it'd be a bit like giving your 3-year-old kid the nuclear codes. Okay, it's not a good idea. And the thing is, they can still behave in a Wild West fashion elsewhere, but the one part of the Wild West they can't be is banks creating money by making loans. If we allowed them to do that, then the bubble we saw in margin debt would be ridiculously small compared to the one that they would create. So it's incredibly important to restrain their tendency to speculate, but to have them regard themselves as being the engines of innovation in a capitalist society.
So isn't that
engine,
so? In that
which
case,
they're not.
Right. Okay. But if they were, I mean, if we had shadow banks that were more innovative than normal banks, and that they were helping to innovators to push forward with new products and services. That's great, because if banks are not doing that, then somebody needs to do it. And if they're doing it without, those shadow banks are doing that without creating extra money, and the only way that the money supply is increasing is either from government spending or from banks issuing loans, and they're doing that in a very boring way, very controlled way, then that is the best of both worlds, isn't it?
And the third, the building societies in there as well. And have them being exclusively for the housing market, because the bubble in house prices is caused by bank lending for mortgages. So, but yeah, I think what we have a system we should regulate, but the ideology of anti-regulation took over economics and took over policymakers as well. And what that means, we're given, I think, banks and merchant banks in particular a license to misbehave, which they've gleefully exploited. So it is very dangerous to treat what is actually a privilege, the privilege of being a bank, as something which is a right because you happen to own the bank. You only own the bank because the government they let you become a registered bank, and it expected you to do that and in a responsible fashion to create the money needed for the society. But they don't do anything like responsibly. And they're always arguing for less and less limitations on themselves. And, again, I come back to Keynes. When you leave the investment decisions of a country to the activities of a casino, the job is likely to be all done.
Well, it's interesting, isn't it? A final point for today, that but please comment on it. It seems that there are attempts to try and regulate the shadow banking sector. So the EU produced a report on just that recently, but their whole focus was on how banks should limit their exposure to the shadow banking sector. So they isolated the concerns around liquidity problems, interconnectivity, and spillovers. So the fact that there's interconnectivity between all these shadow banks, if one was to get in trouble, then lots of them would as well. Excessive leverage. Well, they're not borrowing money that they don't have, as we've said, and then opaqueness. And this is the big thing, isn't it? No one really knows the complexity of it all. Basically, doesn't have a clue what's going on. So looked at all of that, identified that they were all problems in the shadow banking sector, and that there needs to be controls on how banks limit their exposure to all of that. But obviously, their regulation is looking at, this is what banks need to do to limit their exposure. Let's let the Wild West continue. Which, maybe that's the sensible way forward, but that completely ignores the fact of what the shadow banking sector might be doing to the poor man and woman in the street who might have money tied up in them, in whatever instruments it is that they're providing. Yeah,
I mean, they could play a creative role in the physical economy instead of playing a creative role in the financial economy. And we'll let finance get to be far too dominant, and the main form of power comes out of those bank executives, and they're the ones politicians meet up with and discuss and regard as the most important people in their constituencies. So we have we used to have what Eisenhower called the military-industrial complex. It still exists, of course, but what I see as the main danger today is what I call the politico-finance complex. And because politicians are mixing with financial people all the time, they see the world through their eyes, and that means that allows us to do more speculation, more mergers and buybacks, share buybacks, all the stuff which is actually destructive of the productive capacity of capitalism.
Right, but it'd be very hard to tell a company, wouldn't it, that you can't do a share buyback if you feel like if you've got the money and you can't invest it in any other way, and you feel like it's the best thing for your shareholders. Personally, I think it's a complete lack of imagination if a company has to do that. That means they can't expand and do better for their shareholders. The only thing they can do is buy back more of the company. It's an admission of defeat. But if you want to do that, it's pretty hard to say that you can't do that, and you need somebody to facilitate that for you. So you can't say, well, no, we're not going to provide. You're going to have to do it yourself because we're going to legislate against companies doing it for you. So I mean, it's That is part of the problem, isn't it? Where do you draw the line on all of this? And then there's also just the that complexity issue that was raised in that EU report. It is complicated. Hence, politicians tend to say, well, you're the bankers, you're the experts, so whatever they want goes, because nobody really fully understands it. Isn't that part of the problem?
Yeah, it is. I mean, we have a public understanding and high-level intellectual and bureaucratic understanding of banking, which is completely wrong. That's one reason I built my Minsky software. By the way, I'd better mention anybody who's any nerds out there, Minsky 3.0 has just been released. We're no longer in beta. We've now got a final production version. But yeah, you have people who simply do not understand how banking itself works, who are running banking. And that is always a recipe for disaster.
But do you feel like if the intent was there, it would be possible to regulate shadow banking, to say there's certain things you just cannot do, there's certain rules we need to put in place in this banking sector? You're not a bank as such, but you're dealing with money, and therefore these are the rules you have to follow.
Oh, we could say, for example, I'd like to ban margin debt. I think margin debt's played an incredibly negative a role in society. We should simply ban it, and that would mean being banned, it couldn't be done by merchant banks.
Right, but if that bank has got that money available, that what do they, that they can say to somebody, we'll loan you this money because we have it. What do they do with that money otherwise? Well,
they find worthwhile businesses. They find investors rather than speculators. This is what they should be working with, and that's it's the failure to respect the physical economy that the financial sector drives that's led to a lot of the ludicrous over-financialisation of society and diminishing of manufacturing in the West over the last 40 years. So I think that overall I see finance as being a very destructive force on the development of certainly of Western economies. In the East, of course, they've facilitated the growth of the manufacturing capability of the Third World. So they might be beneficial to the Third World, but it's been pretty damaging to the first.
Right. So the answer is not nationalise it then? Is this because it's too complicated?
No, I'm not going to nationalise. I'm saying realise you have rules you can
regular
impose.
Listeners, Steve Keen does not want to nationalise the shadow banking.
Something, that's right. There's something. Definitely don't nationalise restaurants. Okay, that's a disaster. Having experienced canteen food at university, I know how much better it is to have the market developing it. But we've got to choose the right scale and the right institutions to do it. And like in energy, I'd want to see the production and distribution of energy being nationalised. But in banking, I'd like to see the responsibilities of shadow banks being enforced by rules on their behaviour, and particularly abolishing particularly destructive elements of their current activities, like margin lending and so on.
Right, but there doesn't seem to be any appetite for that whatsoever, does there? I mean, as I say, whenever anyone's looking at how you regulate the shadow banking sector, like the EU, they're actually just looking at how banks should limit their exposure to it, rather than actually tackling the behaviour itself. So that shows, that either people don't understand it, it's politically seen as unimportant, perhaps, or everyone's quite happy to see this risk, this Wild West element of the finance industry to continue. Perhaps because there's too many people making too much money out of it, perhaps, and they're powerful people, obviously. I mean, imagine if that was. I'm sure that's not the case, but imagine if it was. That might explain it. Good to talk, Steve. We'll catch you again next week. Thanks for that.
Okay, mate. Bye.
We should point out that Steve has done the last couple of podcasts while recovering from an operation to get rid of his prostate cancer. So what a trooper, basically. Now, with the coming financial crisis, we're all going to have to be troopers, particularly if you're running a business. High inflation, rising wages, higher interest rates, supply shortages. How can businesses navigate through all of that, and what should the government be doing to help? That's next week on the Debunking Economics podcast with Steve Keen. We'll see you then. Thanks for listening.
The Debunking Economics podcast.
If you've enjoyed this podcast, then please share it with your friends, like it on YouTube, and subscribe to this channel.